Welcome back to Commodities Corner. I'm Elaine Stenson, and today we're looking at gold prices, which have steadied on Thursday off the previous day's 4-month high under pressure from a firmer dollar, while buyers of coins, bullion and jewellery in Asian markets held off in expectation of a further price drop. Ross Norman, CEO of Sharps Pixley in London, joins me on the line now. Ross, is there a lack of serious physical demand that means the bullion remains at the mercy of investor and dollar sentiment?
No, physical demand remains very buoyant, and I think we've seen that from figures that have recently been reported out of both Hong Kong and China in terms of imports into the region coming in at over 1,000 tonnes. Indeed, it's also surprising that Indian demand remains as strong as it does, bearing in mind the successive increases on import duties from 2 to 4 to 6 to 8 to 10% duty on Indian gold, meaning that Indians have been paying somewhere around 17 to 20% premium for their gold. Notwithstanding that, demand has nevertheless been close to 1,000 tonnes as well out of that region. So I think actually bullion demand, broadly speaking, remains very, very good. In the short term, however, there is some little bit of weakness in physical demand, and that's, I think, reflected in some of the premiums that are being secured for gold in those regions. Singapore, the premiums have roughly halved to about 80 cents an ounce, and Hong Kong has also come off, as has Tokyo. So only in the very recent short week or two has there been a little bit of softness in physical demand. But in the main, physical demand in Europe and in Asia remains particularly buoyant. And I think actually it's driving the price quite nicely.
You mentioned the short term there, Ross. What effect has the geopolitical tensions in Ukraine had on gold prices in the last week or two?
Yeah, that's a good question. It's sort of a mixed answer to that, really. It's good and it's bad. It's sort of two countervailing currents, if you like. On the one hand, this increasing geopolitical tension has, I think, underscored gold's role as a safe haven asset, and I think it's actually been a big part of the short covering rally that we've seen. It's been taking place on the US futures market in particular. On the other hand, the US dollar is also seen as a safe haven, and of course we've had some dollar strength, and of course dollar strength normally translates into gold weakness. So it's been both good and bad for gold. It's been good because I think people fear that this may escalate, and of course gold has its role as a safe haven, but so does the US dollar. So notwithstanding that, gold nevertheless in the main has also had a bit of an uplift from this increasing geopolitical tension. And I think, as I say, it's underscored that short covering rally that we've seen since the beginning of the year.
And gold has risen more than 10% this year on uncertainty over the pace of the US economic recovery, worries about growth in China and renewed interest in bullion-backed exchange-traded funds. US gold futures for April delivery were up $4.90 an ounce. Were you expecting such positive data?
Well, it's again a mixed story, isn't it, really? And I think we all felt it towards the end of last year that it was going to be the US economy that pulled the global economy out of the ditch, so to speak. Well, the answer is that the U.S. economy has seemed to have softened somewhat, and it does also appear that whatever is done to stimulate the U.S. economy is conversely bad for emerging markets, and we're seeing that in China right now. So at the moment, there are some questions being raised about the pace of economic recovery across the board. So what does that mean for gold? Well, it's interesting to see, you mentioned there, gold ETFs. Now, that was the main driver, if you like, of growth over the last decade. Last year we saw over 880 tons of gold sold from that sector, roughly a third of all ETF gold holdings. Now this month, for the first time, we've seen a reverse in that trend. We're starting to see investors coming back into ETFs. In fact, it grew by about 10 tons in February. So that's the first rise in about 1 year. So it does feel as if your average investor, particularly in the US, is perhaps revisiting their position vis-a-vis gold. So this is sort of shifting of the tide, if you like, in gold investment selling, now becoming buying. I think it's also encouraging some additional short covering on the futures exchange as well. In short, we feel as if we're at the beginning of a gentle but quite clear escalation in gold prices from here.
OK, Ross, we'll have to leave it there for now. Thanks for joining us today. And that's all we have time for now, but do check back for further interviews later. Bye for now.